Hello and welcome to my first InvestEngine portfolio update for a while. In this video, we're going to go through my SIP, my self-invested personal pension, and my business account, which I haven't shown before, which is relatively recent. So these are now the two accounts that I have on InvestEngine. Before we jump into the portfolio, I wanted to just do a very quick market roundup of the latest news, just to kind of reiterate the point that timing the market is a fool's game. So over the weekend, we obviously had the news that Trump authorized the attacks against Iran and bombed the nuclear facilities. And since then, unsurprisingly, there was some scaremongering and people thought the markets were going to open in the red on Monday. But actually, on Monday, when the London Stock Exchange opened, so we could see our S&P 500 global funds, whatever you hold, they actually opened slightly in the green. So for me, this is as good as a reminder as any that we cannot predict how the stock market will react to events. Even things that seem as obvious as this, it seemed incredibly obvious that Monday was going to be a red day given the news, given the uncertainty going forward. How will Iran react? How will other countries react? What will happen? There's a lot of uncertainty. There's a lot of perceived volatility, but in fact, that has not translated to volatility in the stock market yet. Of course, things could change. By the time that I finish recording, editing, uploading this video, it could be a very different situation, but that doesn't change my point here. My point here is that given what we saw over the weekend, I bet everyone watching this video would have expected the market to be down on Monday. And there's probably a lot of traders that have lost money this morning by trying to be smart and thinking the market will go down. So we're going to start off with my SIP, my self-invested personal pension. And we can see, just jumping in straight away here, on the 1 month view, we are up by 1.64% on a time-weighted return basis, or £288 in simple nominal terms. And yeah, we have seen that despite there's been quite a bit of volatility, quite a bit of news over the past month, we're actually slightly up, which is good to see. If we switch to the max chart, it may get a bit confusing here because I'm down £243, but the time-weighted return is 13.7%. So this is where time-weighted return can get a bit confusing and not very useful for my portfolio at the moment. And that's because when I started my portfolio, I just put £100 into this SIP just to try out the InvestEngine SIP. And I didn't start seriously contributing to it until about a year on. So the time-weighted return started from this £100. So on a time-weighted return basis from that £100, I am up 13.7%. However, I've had significant contributions since then, deposited money whilst the market is way up from where that initial £100 was at. So that's why it can end up like this. The nominal return is down by 243, but the time-weighted return is in the positive. We can actually toggle this button here to show buy-sell activity. And if we just go to the 6 month view, you can see that 6 months ago, I only had £4,600 in my SIP. So I have made up some significant contributions in February, March time. And that's because I was getting contributions in before the tax year ends. Because with SIPs, I wanted the contributions in that previous tax year to lower my self-assessment tax bill, because automatically I get the basic rate tax relief added by InvestEngine to my SIP, but also I can claim higher rate relief on my self-assessment for the 2024-25 tax year. So to reduce my self-assessment tax bill for the 2024-25 tax year, I made these contributions before the tax year ends. And that brings me on to my next point. If I go down to what I hold in the portfolio, you can see that I am slightly down on my investments, especially on the small caps. I'm down by over 10%, but even on the global fund, I'm down by 1.29%. If we click onto it, we can see that I've actually been buying close to all-time highs. So it's not really ideal that I had these big transactions go through, £1,000 there, £3,600 there, pretty much almost all-time highs. And this is a case where I just invested regardless of what the market was doing, because the benefit of that tax relief and lowering my self-assessment tax bill far outweighs trying to time the market. So even if we talk about timing the market being a fool's game, regardless of what type of account you're using, especially with a SIP, because I'm focusing on getting the tax relief, the benefit of that tax relief, that is so much more important than potentially waiting, hoping for a dip. Because obviously with the benefit of hindsight, you could have thought, oh, if I waited a month or two, I could have got the big dip and invested in the big dip with my SIP contribution. But actually buying on that dip would have been a new tax year. So then these SIP contributions would not be in the 2024-25 tax year, which is what I needed to reduce my self-assessment tax bill. And again, as a long-term investor, I'm perfectly fine with being down on my SIP because I'm 26 at the moment. I can't access this SIP for 30 plus years, probably about 33 years by the time, 33, 34 years by the time I get there, because the pension access age is going to 57 in 2028. But honestly, by the time I get to 57, I don't think it's still going to be 57. So I'm going to hope that SIP access age, pension access age doesn't go above 60. So let's hope that I can access my pension at 60. So I have 34 years of compounding for the stock market to recover, for this investment to grow. So why would I care about how it's performing right now? It's completely nonsensical for me to worry about my pension at age 26 in terms of how the stock market is doing, in my opinion. A closer look at the funds. So 90% of the portfolio is in the SPDR, MSCI All Country World Index ETF. This is also the larger position in my ISA. It's a simple global index tracking ETF that contains both developed and emerging market stocks. The reason I chose this one is because it is one of the cheapest options available. Total expense ratio is 0.12%, and it's also got a pretty big fund size, over £2 billion. Scroll down to look at the holdings. One of my favorite features of InvestEngine, we can see dominated by the Magnificent Seven companies. That's just the state of the stock market at the moment. We're used to seeing these names: Nvidia, Microsoft, Apple, Amazon, Meta, and so on. And if we go to regions, we can see that a global fund at the moment is around 63% North America. So that's the USA and Canada, but Canada's only going to be about 2 to 3% of that. 60% is going to be the US stock market. And then the other 10% of my SIP is in small caps, and this is the LNG Russell 2000 US Small Cap ETF, ticker RTWP. So Russell 2000 is a small cap index, but importantly, you can't tell from the fund name here, but it's the Russell 2000 with a quality filter. So it filters out loss-making companies pretty much. It's kind of, you can think of a quality filter as similar to a profitability filter in that it only includes profitable companies. Now, if I was building the SIP from scratch today, I'd probably go with the Avantis Global Small Cap Value Fund, which is the small cap fund I have in my ISA. The reason why I hold this one and not the Avantis Global Small Cap Value is because at the time of deciding these allocations in the SIP, the Avantis Global Small Cap Value was not available on InvestEngine. It now is. So with further contributions, I will probably have the Avantis fund as my small cap allocation. And speaking of further contributions, unfortunately, I don't have any plans to add anything further to this SIP at the moment, because at the moment, with the InvestEngine SIP, you can only do personal contributions. You can't do contributions from your limited company. And as I have recently set up a limited company over the past few months, I want to be able to make contributions directly from the limited company to a SIP, because that is the most tax efficient way to do it as a limited company director. So hopefully InvestEngine adds that functionality soon. But in the meantime, it's still a great SIP for personal contributions and reducing your taxable income. So now I've switched over to my business account, which I haven't shown before on the channel. I've only had a limited company for a few months, and I created this account pretty much when I started the limited company, because I'm basically using it as a place to store excess cash that I don't need for any short-term purposes in the business, so I can make some sort of return on that cash whilst it's not immediately needed. I say cash, but obviously once it's invested, it is no longer cash, it is an investment, to be clear. Now, I'm not an accountant, but to briefly summarize the general taxation when it comes to business investing, interest and capital gains are subject to corporation tax, but dividends that you receive from investments are not subject to corporation tax, because dividends already come from profits that have been subject to corporation tax. Of course, the tax treatment depends on your business's circumstances and may be subject to change. It can also be a quite complicated matter, so be sure to consult with your accountant if you are thinking of investing in your limited company. Looking at the portfolio here, you can see I have just over £5,000 and I've got a return of 1.25% on time-weighted return basis, £31 up. So nothing amazing, but I hold in this portfolio the Amundi Smart Overnight GBP Hedged ETF. So CSH2, this is a money market ETF. So I've covered these before on the channel and in a recent email. A money market ETF basically aims to give a return close to the central bank rate by tracking the SONIA, the Sterling Overnight Index Average. These are very low risk funds because they invest in short-term, highly creditworthy debt to give that return close to the central bank rate. At the moment, the central bank rate is 4.25%, so that's kind of what you can expect from a money market fund. They are very low risk, but of course, remember, very low risk does not equal zero risk. And just to reiterate here, the official description on InvestEngine, this ETF aims to achieve short-term returns higher than the benchmark rate SONIA with extremely low volatility. SONIA stands for Sterling Overnight Index Average and is the average interest rate banks lend money to each other overnight. In this case, this ETF is aiming to slightly outperform SONIA, and from my experience, money market funds do actually usually slightly outperform SONIA with the short-term debt they hold. I say the short-term debt they hold, but I think this is actually a synthetic money market ETF, so it technically doesn't hold it directly, but it gives equivalent returns. To go a bit further, it says the ETF is aimed at investors looking for a safe place to keep their money with a little more growth than a traditional savings account might offer. It invests in very short-term, high-quality debt from governments and companies, making it less risky. This ETF is very suitable for me and my business savings at the moment because I'm still building up the company savings. I don't have enough in the business yet to be thinking about long-term investments. I just want to put the spare cash, still accessible, still low risk, but actually working for me and getting better returns than what I can get on business savings accounts. I'm not sure how often I'll show this business account because obviously if I just have a money market fund, it's not too exciting, but let me know in the comments below if you want to see this more often because I'm happy to show it. And I think investing doesn't always have to be exciting because there's different strategies and it shows that there's different ETFs based on different circumstances, different risk tolerances and what you actually need the money for. And in my case, because I might need the money in the short term, I definitely wouldn't be risking it investing into stocks. So that is it for this portfolio update on InvestEngine. My SIP strategy is remaining the same, 100% invested into equities, not worrying about what the market is doing because I cannot access it for decades. I will maybe contribute from my personal income, but no time soon. And hopefully InvestEngine does soon add the possibility to add directly from a limited company. And then I might think about setting up a regular monthly payment from my company to this pension to have as a second pension alongside my main workplace pension. As always, let me know your thoughts in the comments below and thank you for watching.